You are 26 years old. You have $37,000 in student loans at 6.53% interest. You have $2,200 in a checking account. You just got your first real job. The salary is $62,608. Both of you, same salary, same debt, same Tuesday in March. That's where this splits. Path A. Pay it off first. You look at the $37,000 and you feel something specific, not panic, something quieter than panic. You decide, kill it first, everything else after. You set up automatic payments of $800 a month toward the loans. That's $383 above the minimum. You open no brokerage account. You do not check the market. You do not read about index funds. You read exactly one thing, your loan balance. Month 1, $36,400. You go back to work. Path B. Invest while carrying debt. You look at the same $37,000 and you calculate. The loan rate is 6.53%. The S&P 530-year historical average is 10.1% nominal. You open a Roth IRA. You fund it $500 a month. You pay the minimum on the loans, $417 a month. The math says you come out ahead. You are not wrong about the math. Month 1, $417 toward debt, $500 into the market. Balance, $36,783 on the loan, $502 in the account. You go back to work. Age 28. The grind. Path A. You are 28. The loan balance is $21,696. You have been at this for 24 months. You have not taken a vacation. You went to one wedding and drove instead of flew. Your friends ask if you're okay. You are okay. Around month 18, the balance crosses below $25,000. You run the math. At $800 a month, the payoff date is 30 more months. Specific, not someday. You can see the end of it now, which is a different thing from knowing it exists. Path B. You are 28. The loan balance is $33,000. The Roth IRA has $12,841 in it. On paper, the net looks similar. You check the portfolio the way some people check a scale, hoping, then not hoping. The market dropped 11% in month 19. The Roth balance fell to $11,400 in 1 week. You did not sell. You kept paying the minimum. You kept contributing. You were right not to sell. It came back. But for those 3 weeks, $1,441 of unrealized loss sat against $33,000 of very real debt at 6.53% interest, compounding every day without asking your permission. Checkpoint. Age 28. Path A. Debt, $21,696. Invested, 0. Net, negative, $21,696. Path B. Debt, $33,000. Invested, $12,841. Net, negative $20,159. Path B is $1,537 ahead on paper. That gap will not hold. The first rule, the average is not the guarantee. The market gives you 10.1% across decades. It does not give it to you in the sequence you need it, in the years you need it most. Age 30. The crossing. Path A. Month 54. A Tuesday. You are sitting at your kitchen table, the same bowl of cereal you have been eating for 4 years. The payment processes. The balance reads 0. You screenshot it. You send it to nobody. You hold it for a moment. You thought you'd feel different. You do not feel different. You feel the specific absence of a sound you had stopped noticing. You saved $7,744 in interest by paying $800 a month instead of the minimum. The loan would have cost $13,483 in total interest at minimum payments. It cost you $5,739 instead. The next morning, you redirect the $800 a month into a Roth IRA and a brokerage account. $500 to Roth, $300 to a low-cost index fund. You do not touch the accounts. You do not look at them daily. You are 30 years old. You have $0 in debt. You have $0 in investments. You have 35 years until 65. Path B, you are 30. The loan balance is $28,900. The Roth IRA has $26,400. You are nearly positive on paper. The net is slightly negative. $26,400 minus $28,900 equals negative $2,500. But you have been building for 4 years. The trend line looks good. Your loan payoff date, at minimum payments of $417 a month, is month 122, age 36. You tell yourself, the investments will have compounded by then. You are not wrong. Age 35. The machine. Path A. You are 35. You have been investing since 30. 5 years. The Roth IRA Plus brokerage has grown to $50,607. No debt. You are behind Path B's balance. You know this. The accounts compound whether you think about them or not. The machine is running. What you need now is time. And time is the one thing that pays you back for the years you spent not investing. Path B, you are 35. The loan balance is $15,200. Still carrying it. Month 108. 14 more months until it clears at age 36. The Roth IRA has grown to $74,929. You have been compounding for 9 years. The balance is $24,322 ahead of Path A. You feel vindicated. You should. At 35, the math has gone your way. Checkpoint. Age 35. Path A, debt, 0. Total invested, $50,607. Path B, debt, $15,200. Total invested, $74,929. Path B leads by $24,322 on invested assets. This is the part of the story where Path B looks like the obvious winner. It is not over. The second rule: what you clear, you keep. Freed capital compounds without friction. Debt does not pause while you build. Age 36, the crossover. Path B, month 122, a Tuesday. The loan payment processes $0. You feel something, not the quiet absence Path A felt. Something warmer. You carried both obligations for a decade. You invested through it. You did not flinch. You are 36 years old. The Roth has $82,000, no debt. You redirect the $417 that was going to the loan into the brokerage. You now have $917 a month going into the market. Path A at 36 has been investing $800 a month for 6 years. Total, $67,000. Path B at 36 just cleared debt with $82,000 already compounding. Path B still leads by $15,000. Age 45, the wait. Path A, you are 45, total invested, $240,170, no debt since 30. The accounts have grown for 15 years from a zero base. You did not inherit anything. You did not get a windfall. You cleared $37,000 in debt and then did not stop. There is a contractor named Rajan who walks your rental property with you. His estimate for the roof, $14,200. You write the check without checking the account first. That is a different experience of being powerful. Path B, you are 45, total invested, $237,125. The gap that was $24,322 at age 35 has shrunk to $3,045. Path A is now ahead. This is the moment the math turns, not dramatically. $3,045 on a $240,000 base is barely noise, but the direction has shifted, and direction is what compounds. A fee-only planner named Shreya does the projection at 65, Path A at 65, 35 years of investing at 7% inflation adjusted, $1,386,724. Path B at 65, 39 years of investing at 7% inflation adjusted, $1,386,724. $218,150. The distance, $168,574. Shreya does not say which path was right. She states the figures. She charges $2,400 a year. You pay it. The third rule, the compounding does not care which path felt smarter in year 5 or year 9. It cares only about what entered the account, when it entered the account, and what was pulling against it from the other side of the ledger, what the numbers do not show. Path A. 54 months of paying $800 toward debt while watching friends open brokerage accounts, talk about their Roth balances, check market returns. 54 months of FOMO that was not irrational. The market did go up during those 54 months. Path A missed it. The total missed growth shows up clearly at age 35. Path B leads by $24,322 at that point. That deficit is the price of Path A's strategy. By age 43, the price is paid. By age 65, Path A is $168,574 ahead. Path B, 122 months of carrying debt while investing, over 10 years of holding 2 obligations simultaneously, 3 market corrections during that period. Each one felt different when $25,000 in debt at 6.53% was running in the background. Path B never had a month where it owned its cash flow entirely until 36. Path B investors who hold both obligations for the full 122 months do not lose badly. They lose by $168,574 on a $1,386,724 base. That is 12%. 12% is not nothing. 12% is also not a catastrophe. What determines which path wins? The interest rate on the debt. If the debt is at 4% or below, a federal loan refinanced in a low-rate environment, a mortgage, Path B wins decisively. The spread between 4% and 10.1% nominal means every dollar in the market returns substantially more than every dollar of early payoff. If the debt is at 6.53%, the current federal undergraduate loan rate, it is nearly even for a decade. Path A wins in the long run due to behavioral factors. No sequence risk, no divided cash flow, one obligation at a time. If the debt is at 9%, 15%, 21%, the current average credit card interest rate is 21%. Path B is not a strategy. It is a slow bleed dressed as discipline. There is no market return that consistently outpaces 21% guaranteed interest on a revolving balance. The market gives you 10.1% nominal on average. The credit card takes 21% on certainty. The average loses to the certainty every time. Past performance does not guarantee future results. These figures are historical averages. Individual years vary widely. The machine doesn't ask which path you chose. It opens every morning and takes whoever shows up with unencumbered capital and patience that does not require permission from a lender. Path A arrived at 30 with nothing, no debt, no savings, and let 35 years do the work. Path B arrived at 36 with $82,000 already compounding, but 6 years shorter on the back end and 122 months divided. At 65, Path A has $1,386,724. Path B has $1,218,150. Both cleared $1 million. Both got there by showing up consistently, without flinching, for decades. Somewhere right now, there is a 26-year-old looking at a $37,000 balance and a $62,608 salary, running the same calculation both of them ran. They don't know yet that the math is almost survivable either way. They don't know yet that the answer lives entirely inside the interest rate on the debt, not inside the argument about which path is smarter. What they choose will be clear at 65, not before. The balance reads $37,000. It always starts there.